Afternoon. Welcome to this week's class today. Once again, my name is Jason Shepard. I am an IRA specialist with NewView Trust. And today we're here to talk about maximizing returns with tax-advantaged investing. Basically, what accounts are available, how can you put money away tax-advantaged, and then dive in a little bit about a little bit more of a passive strategy with investing within real estate. We'll talk about that from there. So, as always, before we get started, NewView Trust serves as a passive custodian for alternative investments. We do not provide legal or investment advice, nor do we sell investments. Also, we don't provide tax advice. I know this will talk about tax advantage strategies. Want to make sure we're clear. We're not offering advice, just giving you more of what you could do, not what you should do type of conversation today. We also hold HSAs, ESAs, and 401ks that hold alternative investments for our clients. So what is self-directed IRAs? If this is your first time attending a NewView class, an IRA, self-directed IRA is an IRA which the IRA owner or individual retirement account owner directs all investment decisions. But self-direction, we always want to point out, is not a type of IRA. It's a marketing term. All IRAs are IRAs in the eyes of the IRS, which that's a little bit of a mouthful, but all IRAs are IRAs. Self-directed is just what you do on the back end. The way I like to think about it is IRA is just a piggy bank you're putting those funds into, and then whether you self-direct or have it in the stock market, that's more like what you plan to take that piggy bank and invest into. So just think of the IRA as a special savings account. Benefits of self-direction. First is diversification. We'll talk a little bit about diversification when we're talking about passive real estate investing later on in the topic. So we'll skip that and save that for later. Tax savings. This is a benefit. All funds that go into a traditional IRA, a SEP IRA, a simple IRA, a solo 401k can all be pre or post tax. So there's many different ways to save taxes now, and as well as strategies to save taxes later on after you retire. And the best benefit, in my opinion, to self-direction is investing in what you know best, right? You're not just hoping to gamble right and make good bets on the stock market. This gives you the ability to invest in private businesses, invest in real estate, invest in precious metals if that's what you want to do. Gives you the freedom to invest in that and let you kind of take control of those investments. As we discussed, there's many different types of IRAs that we offer. All of the plans we offer can be self-directed. The traditional, the solo 401k, the SEP IRA, the simple, and the ESAs all have pre-tax opportunities inside of them. And this just gives you the ability to put money away tax-free and invest it, let it grow. And then you don't have to pay taxes on it until later on when you decide to pull funds out of it. Roth IRAs, and as well as if you choose to have Roth contributions to your solo 401k, those are accounts where you pay the taxes now, but after it grows and after you invest it and let that piggy bank grow a little bit, you don't have to pay taxes on them later on. Each personal IRAs or individual retirement accounts do have a cap of $6,500 with an additional $1,000 catch up after the age of 50. SEPs and solos, their limits, as we always discuss, $66,000. And the solo has an additional $6,500 catch up over the age of 50. Simple IRA, 15.5 with an additional 3,500 And then the ESAs had an ESA, which is an educational savings account, as well as a health savings account, which is an HSA. Those have their own limits. Education savings, 2,000. And then there's slightly different changes for the health savings account there for you. So all plans, like we talked about, offer that tax advantage status and allowing those investments to grow in that tax advantage status. Because once again, if it's in a traditional IRA, a traditional 401k, SEP IRA, simple IRA, you're not paying taxes when you put it in. Education, health savings accounts, you're not paying taxes now, you're paying taxes when you start taking the funds out. In fact, education and health savings, you don't pay taxes when it comes out, as long as it's for a qualified expense associated with those accounts. So as far as IRAs, one of the things to consider when you are investing with your IRA are the restrictions. What can or can't you do with your IRA? So the IRS is pretty clear. There's only a few things you cannot do. One is there's certain people you have restrictions on, and we'll touch on that further. There's also a few transactions and investments you are not allowed to do with your IRA. And we'll touch on those in later slides. First, people restrictions. So your IRA, and the easiest way I remember it, your IRA is like your imaginary friend that's walking beside you. The IRS says you and your IRA cannot do business together because you are two separate entities in their eyes. If you do decide to do business with them, there's special rules and restrictions that you need to do in order to do business with a restricted party. So the first one, moving from inside out, is the first restricted party is yourself. The next restricted party is your spouse. Then following that is your ascending or descending lineage. So what I mean by that is your kids and grandkids, great-grandkids, and everyone down on your lineage. And then your parents, grandparents, great-grandparents, and everybody on the upside of that lineage. Those kind of cover all the family members. The next step is a corporation. So if you are an officer or director, 10% or more partner, a highly compensated employee of that business, you cannot do business with that business and make investments with that business if you meet those guidelines. Partnership, if the fiduciary, which is the IRA, includes the IRA owner, is 50% or more of capital and profit interest in that business. So if you're a 50-50 partner or more in a business, or a highly compensated employee of that business, it gets a little complicated, not to get redundant. Or if a trust or estate owns 50% or more in a beneficiary interest, that also includes those parties as well. So basically, easiest way, here's your IRA, can't do business with you, your family members, businesses that you're either owner of or partner in, or if any of those trusts deals directly with that fiduciary, or any combination of those. It's very strict about what they do business with. It's not saying you can't do business with those parties. If you choose to do business with those parties, there's very strict guidelines you want to make sure you're following. Basically, is making sure that the percentage that you enter that investment in with those parties, you exit at that same percentage, and those percentages can never change during that investment. So that way it's not considered a prohibited transaction. Let me pause there. Are there any questions in the audience for prohibited parties on that? Perfect. Transaction restrictions: you cannot buy, sell, trade, or loan or extend services. So basically, you can't do direct or indirect services with those transactions. The other thing are investment restrictions. Those are going to be life insurance, as well as collectibles. So memorabilia, art, things like that are off limits and not allowed to invest in those types of investments. So now that we've covered IRAs and we've talked about disqualified parties and disqualified transactions, touch on another common investment vehicle is understanding, talking through the passive real estate investing and what exactly that looks like for you. So passive investing is investing in real estate properties or projects without active. So no toilets, no tenants, no issues like that. But you get all of the returns through rental income, the property appreciation and selling it later on, and other benefits, especially some of the strategies through limited partnerships and syndications. You can actually get that return on investment after a few years when they choose to either sell the property or refinance and take full ownership of it after the property is already up and running. At that point, you can then potentially earn that return on investment after 3 to 5 years, I believe. So there's a few different ways to go through that, but most importantly, you're not involved in the day-to-day operations of that business. Very passive, very easy to allow and just watch it grow. So the advantages of that is steady returns, right? You get regular income generated through rental payments and distributions. Some companies will do a quarterly distribution. Some companies will do even a monthly distribution, depending on the investment platform from there. Freedom from property maintenance. Like I said, no toilets, no tenants, no problems on that. So potential tax benefits. There's no capital gains on your growth. You're just taxed when you start pulling the funds out, like we just discussed. If you're investing with traditional funds, the other benefit is, especially if you're purchasing into single family real estate, there's no 1031 exchanges needed. So you're not constantly setting up an additional vehicle for you to then put off those capital gains. And this gives you also the opportunity to diversify. A lot of the multifamily projects that are out there do have projects going on all across the country that may interest you and give you that geographical diversification if you're looking for that, or if you're looking for an asset diversification. It gives you the ability to have a multifamily or some other form of passive real estate on there and include that in your portfolio for the future. Speaking of diversified portfolios, we'll touch on that. Diversification in real estate investing does reduce risk and stabilize the income and captures potential appreciation of those assets. It also gives you the ability to buy and hold some, rent some, sell some, and really capitalize on the changing markets. The market here in Florida is way different than the market in the Midwest, in the West, the Pacific Northwest, all over the place. Allows for that to potentially maximize on those properties, locations, and balance those risks. Weather problems that may pop up in different areas. Obviously we have to worry about hurricanes down here. But that's not an issue in South Dakota. But there they may run into blizzards and other property issues, tornadoes, things like that. So different strategies can result in long-term wealth preservation and increase resilience to market volatility. Strategies for diversifying, we just touched on geographic locations. You're not just restricted to your backyard. There's also property type. Right? You can do single family homes. You can do apartments and condos. You can do multifamily buildings where you own several units inside of a building. You can do commercial real estate. And there's different strategies involved with commercial real estate that allows you to really diversify that portfolio and capitalize on some of these commercial properties that may have long-term tenants with guaranteed income, as well as those that may also handle some of the utilities and other expenses that go on with that building. And then you just need to worry about the maintenance of the physical building, and they worry about everything on the inside. So we'll pause right there. Any questions, anything on the chat about passive real estate investing with the IRA, and see what else is available for you. So anything in the office here in Longwood, or anything out on the web out there for me, Amy?
Yes, we have a couple from online.
Yeah.
The first one is, what are some common mistakes or pitfalls to avoid when engaging in passive real estate investing?
Great question. Great question. The first thing you want to, obviously we already touched on it, but one of the biggest pitfalls are those prohibited transactions and doing business with prohibited parties. Obviously, we just touched on the strict rules the IRS has with those transactions. So you want to make sure you're very careful anytime you're doing business with those parties. Once again, yourself, family members, spouses of your family members, business partners, and so on. A few of the other pitfalls to consider is, anytime you're investing and you're doing a passive investment, beware of potential UBTI or UBIT taxes that are out there. That's unrelated business income tax. That's a tax on the income that you receive from a business that may be unrelated to the original investment. Trying to think. The other pitfall, commonly out there is record keeping, especially with passive investing and real estate investing. You want to make sure that you're keeping records, especially if you're getting a regular income, which we have a team internally here at NewView. If the asset's held directly with your NewView account, the record keeping can be a big pitfall, because you want to make sure you're staying in compliant with the IRS, and you're making sure that everything the IRA owns receives that generated income from there. So just kind of as an example, you have a single family home that's paying monthly rent. You want to make sure that's going to the proper account and not going into your personal name and then back to the account, because that could potentially cause those sorts of issues. Also, repair invoices and expenses must be paid by the IRA that owns that account. So just a few things, prohibited transactions, UBIT, and that record keeping is something you want to make sure you're maintaining. Good question on that one. What else do we have? Anything else inside or online, Amy?
We have two more from online. The
Perfect.
next one are, what are the exit strategies for passive real estate investments, and how can I plan for a smooth exit when the time comes?
Yeah. So the easy exit, especially in real estate, the sale of the property is the easiest one out there. Obviously, you want to consider market conditions, and work with a realtor in your area, a real estate agent that's knowledgeable of the market in that area, and they'll help you identify whether it's a good time to sell or whether it's a good time to hold on to that property. The other exit strategy is a partnership buyout. If you're in a collective, if multiple parties own that property, or if you're in a partnership, the other parties may be able to buy you out. That doesn't go for those disqualified parties we just touched on. But if it's unrelated parties and you want to sell your 50% share to one of the parties, that's something that can be done on that side of it. The other thing is after you have that conversation with the realtor, it may make sense, especially if you're purchasing properties to just sit and hold and potentially do a renovation later on. It may make sense to hold it and develop that passive income by renting that property. where it may not make sense to flip that property, but to sell it, it may end up not returning as much as if you decide to hold and rent it. But as far as having a smooth exit, the way the most important thing I think, if you're not planning for the exit when you enter an investment, that's the biggest thing, is making sure you have that plan before you enter of how you're going to get out, and having that. But ultimately, be flexible also. So like I said, if you have to hold it and have to rent it, make sure you have that plan going in of how much you can generate if you choose to rent it from there. So what else, Amy? You said you had one more?
Yes, the last one is, what is the typical minimum investment required for passive real estate?
Yeah, so on that, there's going to be several different entry points depending on the type of investing that you're doing. One of the most common ways is obviously purchasing a rental income property there. It's not as passive, but that would kind of be on the high end of purchasing the property directly with your IRA. Depends on the property values in your area of what that could be. Then kind of working your way down, real estate syndications or real estate funds. Those kind of have an entry point typically of between 25 to 50,000, and then increasing from there, as well as real estate limited partnerships. Those all kind of have that similar, $25,000, $50,000 starting point, and then they have increments where you can purchase additional, for lack of a better term, shares into that fund for whatever that increment is. So 25, it may be that additional from there. So those have also additional restrictions where it may, you may have to be what's called a sophisticated investor or well-qualified investor in order to participate in those types of investments, depending on that. And then kind of working your way down are going to be kind of your REITs, which are real estate investment trusts. Those are, there's publicly traded and non-traded REITs that are available. And those can be, range from a few thousand to several thousand or more. And then, the most common thing now are these crowdfunding platforms. And those, you may be able to purchase a portion of real estate. There's even, I know there's a few people out there that are doing real estate tokens. So it's almost like a cryptocurrency mixed with a REIT or some sort of crowdfunding, where you're purchasing a token of a property, just like you would purchase a cryptocurrency, which I know we did a class on a few weeks ago. But ultimately, those passive options are anywhere from a few $1,000s on up to probably 100,000 is kind of that good range. I hope that answered that question. I know I kind of circled around and came back to it at the end. So that's where those numbers are. Are there any other questions on there, Amy?
There are not.
Well, perfect. Now, now that we've kind of cleared all that, now you have the choice of how to retire well. So I wanted to touch on this real quick. The most common question I get when a client calls in is, how long does it take to get started? Honestly, we have our applications all preloaded and available online. So you can actually have your account established within 15, 20 minutes. You fill out the application, you send it over to us. We'll take it through a compliance review. On average, it takes about 24 to 48 hours to have the account open from there. That starts a clock on your 7-day right of rescission. The SEC requires us to provide that 7-day ability for you to close the account and not have any issues. We'll utilize that 7-day window to get the funds transferred over and get the account funded and get that whole thing started. Those on average take 3 to 10 days to get that started, get that finished. Once you're on there, you can also assess NewView client events and trainings like this, as well as our podcast. And we'll touch on that here in a few minutes. And that gives you the information, hopefully, to determine your investment choices. You may already have an idea coming in, or you may be a blank slate and want to learn a little bit more. Determine those choices and start negotiating. There are opportunities that may be out there for you, and never hurts to ask. So, what to do next? Scan the QR code right here. You can do this online. Schedule a consultation with us here at the office. Myself and my team can have that conversation with you. We'll determine at that point what account may be best for you, and talk that through with you, or instruct, say, hey, maybe this is a better conversation for your CPA or attorney at that point. We'll fill out that application, transfer the funds, make the contribution, and get that self-directed started. So that is all for this class. Join us next week for Optimizing Your IRA, the Power of Tax Liens and Tax Deed Investments. I'll be teaching you on that. And there's a QR code right there at the bottom of the screen for you to register for that class next week. Also, episode 28, the final chapter of our first season with Jason DeBono, all about alts podcast on all major platforms. Very informative and exciting to see what season 2 has coming for that one. You can stay up to date with all news and information on all the major social platforms. You can use this QR code right here to find those. And lastly, we always want to talk about our foundation, Share the Love, initiated by Glenn and Jason. Glenn, our CEO, Jason, our president here, providing mobility to those in need all across the world. So that is it for today. I appreciate you guys coming today and attending our class, and hope to see you guys next week. Have a great day.